The economic recovery in Philadelphia continues to be inconsistent and lackluster, and that's directly feeding into some inconsistent and lackluster apartment fundamentals. Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons with your Philadelphia update. All across the Northeast region, we've seen pretty unimpressive apartment fundamentals of late, but typically the pattern has been high occupancy rates but very little rent growth. In Philadelphia, we're still seeing low occupancy rates relative to long-term norms and to the regional average, and of course, not much rent growth. And it all starts with what's going on in the local economy. The recovery took longer here to get going, and it's sputtered in its pattern since then. You can see inconsistent growth. It had been looking okay for much of 2012 and 2013, but then dropped off again in Q1 of 2014. Not a good sign considering there's still a large deficit to backfill in terms of jobs lost in the recession. Compared to pre-recession levels, Philly is still down by nearly 100,000 jobs, or 3.4% of the employment base, which is one of the larger holes nationally. And given that economic backdrop, apartment demand, as you'd expect, has been quite volatile and not especially good. And supply, while not at crazy levels, is elevated relative to the norms here. So that's created some lackluster occupancy numbers when you put those two things together. You can see occupancy has hovered around 95% for the past 3 years. And you could also see that it's well below the norms from prior to the recession. Between 2001 and 2007, Philly averaged a rate just north of 96%. Additionally, Philadelphia is well below the Northeast regional norm of 96% as of Q1 2014, and it is easily the worst rate among the Northeast big markets. You can see New York on top at 97.4%, with the remaining big markets clustered right around 96%, Boston, Northern New Jersey, Providence, Hartford, and Pittsburgh. And a quick look at rent growth trends, and you can see there just hasn't been very much of it. It has dropped off for the past couple of years, and certainly below the norms that we saw prior to the recession. And let's hone in specifically on the city center, downtown Philadelphia. Like most urban submarkets, this is one that's been targeted in terms of apartment development of late. But thus far, the new supply isn't stimulating much demand for apartments. And that perhaps traces back to the weak economy. So occupancy has really fallen off of late, down about 300 basis points year over year to a rate of just 93.8%. And rent growth has just disappeared. From 2010 to 2012, this is the one area that was showing consistently strong rent growth in the Philadelphia metro, but not anymore, given that supply pickup and the weak economy. In fact, annual rent change has been negative in 4 of the past 5 quarters, and as of Q1 2014, rents were down 3.1% year over year. So does the outlook look any better for the greater Philadelphia area? A little bit. Job growth is expected to get moderately better, and this is one of the few markets nationally where supply is actually going to drop off by the latter part of 2014 and into 2015. So those are two good signs. It certainly won't stimulate significantly better apartment fundamentals, but we do expect occupancy to tick up a little bit, and for rent growth to get a little better, though still limited at around 2% annually. And that wraps up for Philadelphia. So until next time, for Apartment Market Dynamics and MPF Research, I'm Jay Parsons. Thank you for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.